Hey everyone, so I've been driving for a little bit, but I did want to let you know that some markets can actually be timed. Um, in a stock market, I do believe that you should not time the market. So when it comes to the stock market, I do not time the market whatsoever. But when it comes to real estate, obviously the Fed has raised rates to affect your buying power, and that's equally going to affect the materialistic things that you can afford. And one of those things is real estate. When real estate is now $400 more expensive per $100,000 that you purchase, that's obviously going to affect your buying power and what you can afford. So when it comes to timing the market, it would have been so much easier to have invested early on. For example, I had a big goal of owning 5 properties in the next couple of years. Obviously, that has been halted a bit because I've been wanting to purchase now for almost a year, and I haven't been able to get property number 3 due to the time in the market where we are now in the second most expensive time in my entire life, right? So why would I be purchasing properties in the second most um, expensive time in my entire life? Now, of course, some people might say, yeah, it might be expensive now, but you can refinance later. If property values don't increase significantly, it may take 5 to 7 years in order to refinance. Therefore, you may not be making a lot of money or any money whatsoever. It might even be more advantageous to wait for rates to go down. And that would essentially be like a refinance when you're getting additional cash flow just by quote unquote timing the market. The problem with that is we don't know how far rates will go down when they start to go down. And I actually do believe that rates will go up one more time before the end of the year, and that will be in November. Yes, we're going to skip October. We're going to get one more rate increase in November. In my opinion, values will go up in the savings market as well. So your savings account is going to go up. We're already at 4.5%. So we're going to be inching towards 5% rates in savings accounts. That is mind blowing. I'm talking about no risk whatsoever as long as you believe in the U.S. and their banking structure. There is absolutely no risk as long as you have less than $250,000 in these banks. And you get all the reward, almost a 5% return on your money for doing absolutely nothing. So in that time, I do believe that it is very important to save as much as you possibly can, invest as much as you possibly can, especially in this downturn. It's going to work in your favor. It's going to be super profitable for you in the long run. So right now, all I can do is stack up cash, and wait for my turn in the real estate market. So yes, it is a market that can be timed. Understand that if you do have a property and you have a 4%, 5%, or even 3% interest rate, or even a 2% interest rate, now is the time to try and increase your income. Slowly but surely, just continue to increase your income. The more income you have is going to be such a hedge against inflation, to have a property that is less than 3% right now. And I have 2 properties under 3% interest rates. Therefore, I am literally beating inflation. I'm kicking inflation down. I am stabbing inflation like we're at war. I mean, I am just on cloud 9 when it comes to that. Like, my property is making me money that I could have never dreamed of because literally is under the rate of inflation. And I think that that is a great a feeling to have when you can purchase a property that is under inflation. We all know that an interest rate of 7, 8%, or even 6% is going to be way higher than inflation in most years. So until you get down to about 4, maybe 4.5, is going to be very difficult for me to see a world where inflation constantly is above 5%. I just don't see it. So I need to be in that 4% range, in that 4.5% range. I don't believe we'll go down to 3% rates anymore. Not in the next 10 years for sure. But I do believe that we can see rates hit 4.5%, definitely 5%. And that's where I see it going. I might actually be purchasing at 5. Once you start to see those rates go down, hopefully people are smart and they don't buy. And then rates will continue to go down to adjust to the market. And then when you see people start to put their properties back on the market, it's going to be buyer season. They're only going to lower rates as low as the consumers allow. So if they lower rates to 6% and everybody's jumping into the market, everybody wants to buy, well then guess what? We're not going to get cheap interest rates ever again. And that's why I don't believe we can see 3% interest rates, is because we are a consumer nation and people will consume. When they see rates under 6%, they're going to jump on that as if there is nothing better in this world. And that is exactly why we won't see anything under 4.5%. I believe if you see a 4.5% interest rate, you should jump on it immediately when that time comes. And that will most likely be in 2026, 2025 at the earliest. So again, when it comes to the stock market, we are not going to time the stock market. When it comes to the real estate market, your pockets will tell you what you can afford. And unless you're going to save up a ton of cash, you have to understand that certain things you cannot force. You need to have cash flow. You need to have appreciation working on your side, which means you need to buy in the right locations as well. Make sure you're liking this video. Make sure you're subscribing to this channel. Make sure you're hitting that bell notification so that you're alerted every time I drop a new video. And I post every single day at 8 a.m. daily on YouTube and on Rumble. And I can't wait to see you on the next one. Peace.